Welcome to Stifel's Sightlines podcast, focusing each week on a topic or two important to investors. Well, greetings and welcome to the Sightlines podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. Hey, I wanted to get into kind of the environment. You know, we've been talking a lot about AI, really around the impact on the job market, some investment considerations, some applications in healthcare, and in more broadly, the digital realm. And essentially, knowing that that's all sort of a backdrop to our long-term themes, that's been a bit of a tailwind, right? AI, optimism around AI has been a bit of a tailwind. And among other things, especially with another Fed rate cut, essentially markets have moved higher. And so what I want to get into is the environment, some data that we're seeing in the environment, but really with an eye towards maybe one catalyst for potential market volatility and potentially negative market results being what I'll call a Fed that disappoints in terms of rate cuts. So let's jump into some data, and I'll get into a little bit more what I'm talking about. So again, just to take a step back, we have what has been a pretty resilient environment. So for example, second quarter GDP, I think the final estimate was 3.8% annualized growth, with the consumer being a strong contributor in the second quarter. The S&P 500 through September is up 14.8% year to date. So despite that big decline in April, we've seen strong recovery, and we're up to what, if we ended right here, be a pretty darn good year. Now, while we're not all the way to the 2% target that the Fed identifies, inflation has cooled. And over the last 6 months, when we look at annualized rate, let's say for CPI, the headline rate is 2.3, the core CPI 2.7 annualized rate, PPI really muted, the headline at 1.1%, the core at 1.9, and then PCE, which is known to be a Fed's favorite, has a headline annualized rate of 2.2 and a core rate of 2.5. And again, we can split hairs here a little bit, but these numbers, if we think about where we were a few years ago, if we said we could get back to these numbers, people would look at that and say, that's pretty good. And we're really approaching the Fed's 2% target. So inflation, we're not out of the woods, but there's been real progress. Now, on another front, and the other side of the Fed's dual mandate is the job market, right? The labor market. And so what we've seen is some softening. We know, for example, that non-farm payrolls have been muted. There was a significant correction, I guess, or adjustment to historical data in the negative direction. But really, at the end of the day, despite that, we sit in an environment where we're almost at full employment. The unemployment rate's at 4.3%. Another metric is the JOLTS report, job opening related report. And essentially, we're at 7.2 million. That's well above the pre-pandemic norms. And so we have a job market that is really solid, but is showing some signs of cracks, right? And so here, what I would say is that it was interesting and expected for sure that the Fed made a quarter point, what they called a risk management cut in September. And essentially saying, hey, when we look at our dual mandate, so think of it as prices, meaning inflation, and maximizing jobs, so the labor market, they saw the risks balance out away from inflation, more towards labor, with a few cracks, giving them enough of a reason to cut a quarter point. And really, even up to that date, the market is forecasting another couple cuts through the balance of the year and potentially 2 to 3 next year. And notably that the median forecast for the Fed's what's called Summary of Economic Projections, what's called the SEP report, basically has the median view, if you will, among Fed officials is for a couple more cuts this year. And so then when we look at things like sort of estimates on a view of GDP, there's kind of a wide range. The lowest Fed official estimate or projection is 1.3% for 2025 GDP, the highest at 2%. So that's a pretty wide range. Year-end unemployment, there's a positive view that it's going to go back down to 4.2, a negative view that it's going to jump up to 4.6, and most are leaning towards it getting a little worse, hence that rate cut. And then ultimately, what's very interesting to me is that there are hawks on the Fed, so officials who are worried and maybe think inflation is going to reheat, maybe it's tariffs or whatever. Actually, some that expect a couple quarter point hikes by the end of the year, while the most dovish among them is projecting 5 cuts just between now and the balance of the year, which I think both of those are real extremes, not going to happen in our view. In any event, when it comes to inflation, the SEP is expecting inflation maybe to firm up a little bit. So year-end, a rate of 2.6, the market break even. So the TIPS market is pricing an investor expectation of 2.7 over the coming year. And then we've got, looking forward, a view that the economy is going to continue to grow. So all of this to say, when we add it all up, I think one of the things that we're mindful of is that the market's quick to price in sort of optimism around Fed cuts. And when we look at the data, labor's still pretty good. If we start to see we're not forecasting this, but if we start to see any indication of inflation really reheating, or there's uncertainty, right? Maybe data not being available because of the government shutdown, whatever it might be, there's a chance that the Fed, as it often does, will say, we're going to pause and wait here, look at more data, et cetera. And given that the market's up a lot and the valuations are kind of lofty, we think the market is setting up for the risk that we could see increased volatility and potentially market weakness if things like that were to occur, meaning in this case, the Fed disappointing relative to the expectation around rate cuts. And so anyway, sometimes I feel like what we're up to when we talk through some of these topics is just to get people ready for the current environment not sustaining itself, right? Things tend to move back and forth. And so when markets are really weak, we're probably talking a little bit more about recovery. When markets are really lofty, we kind of remind people to get ready for some eventual downward moves. We're not market timers. That's really hard to do. But we are mindful of where we're headed, and we want to, for long-term investors who ultimately stay the course, the whole idea is to be able to understand and make their way through the volatility without taking great action. So anyway, that's what we wanted to get into in this episode. Thank you so much for listening, and we'll catch you on the next one. Thanks again for listening to Stifel's Sightlines. Be sure to subscribe wherever you're listening to automatically receive each week's podcast in your feed.